The Psychology of Money. Timeless Lessons on Wealth, Greed, and Happiness. By Morgan Housel. Comprehensive book summary. All 20 chapters, complete key ideas, stories, and insights. Introduction. The greatest show on earth. Morgan Housel opens with two contrasting stories that capture the book's central thesis perfectly. First, Ronald Reed, a Vermont gas station attendant and janitor who quietly saved and invested in blue-chip stocks his entire life. When he died in 2014 at age 92, he left an $8 million fortune to his local hospital and library, a complete surprise to everyone who knew him. Second, Richard Fosconi, a Harvard-educated Merrill Lynch executive who borrowed heavily to maintain a lavish lifestyle and went bankrupt during the 2008 financial crisis. The juxtaposition is stunning. In virtually no other field would a janitor with no education outperform a Harvard-trained professional. Yet in finance, this happens. Why? The premise of this book is that doing well with money has a little to do with how smart you are and a lot to do with how you behave. And behavior is hard to teach, even to really smart people. The soft science of money. Finance is taught as a hard science, formulas, spreadsheets, models. But knowing what to do and actually doing it are entirely different challenges. A genius who loses control of their emotions can be a financial disaster. An ordinary person with no formal training but rock-solid behavioral discipline can accumulate extraordinary wealth. Housel argues that financial success is a soft skill, what he calls the psychology of money. The book presents 20 chapters, each exploring a different psychological dimension of our relationship with money. These chapters can be read independently. Together, they form a comprehensive picture of why smart people make poor financial decisions, and what truly drives lasting financial success. Housel draws on more than a decade of writing about finance and behavioral economics. He began writing in early 2008, at the dawn of the worst financial crisis in 80 years, and realized that the crisis could only be truly understood through the lenses of psychology and history, not finance. Understanding why people bury themselves in debt requires studying greed, insecurity, and optimism. Understanding why investors sell at market bottoms requires understanding the agony of fear, not expected return calculations. History never repeats itself, man always does. Voltaire. Chapter 1. No one's crazy. This chapter establishes the foundational idea of the entire book. Every financial decision, no matter how strange it looks from the outside, makes complete sense to the person making it, given their unique life experience. The core insight. People do seemingly crazy things with money. They buy lottery tickets when they're broke. They hold cash during roaring bull markets. They sell stocks in panics. But Housel argues, no one is actually crazy. They are responding rationally to the world as they have personally experienced it. Your personal experiences with money, though they represent a tiny fraction of what's actually happened in the financial world, may constitute 80% of how you understand it. The person who grew up during hyperinflation thinks about cash and inflation differently than someone who grew up in a period of price stability. The investor who started their career in 1990s bull markets has fundamentally different risk instincts than one who began during the Great Depression. People's lifetime investment decisions are heavily anchored to the experiences those investors had in their own generation, especially experiences early in their adult life. Economists Malmendia and Nagel, NBER study, 2006. The generational divide. If you were born in 1970, the S&P 500 grew nearly tenfold, inflation adjusted, during your teens and 20s. If you were born in 1950, the market went essentially nowhere during those same formative years. Two people, separated only by birth year, go through life with completely different intuitions about stocks. Neither is irrational, they simply experience different worlds. Similarly, Americans who experienced the Great Depression carried financial trauma for the rest of their lives. Even those like JFK, whose family was insulated from its worst effects. The knowledge of what's possible stays with you in ways that no textbook can replicate. Finance is shockingly new. Another reason we struggle with money. Most of the core concepts of modern personal finance are less than 50 years old. The 401k didn't exist until 1978. The Roth IRA was born in 1998. Index funds are barely older. Credit cards, consumer mortgages, widespread stock market participation, all post-World War II phenomena. We are asking people to make complex long-term decisions using tools and systems that are brand new. We are all, in a very real sense, beginners. The person who made a bad student loan decision didn't have generations of accumulated wisdom to draw on. Neither did those who got caught up in the housing bubble. We're winging it. Dogs were domesticated 10,000 years ago and still retain some behaviors of their wild ancestors. Yet here we are, with 20 to 50 years of experience in the modern financial system, hoping to be perfectly acclimated. The lottery ticket example. Americans spend more on lottery tickets than on movies, video games, music, sporting events, and books combined. The primary buyers are lower-income households. This looks irrational from the outside. But consider the inner logic. For someone living paycheck to paycheck, who cannot realistically save toward a comfortable retirement, a lottery ticket is the only available vehicle for a dream. It's paying for the feeling of possibility, something those with more financial options take for granted. You don't have to agree with it, but you can understand it. Key takeaways. Every financial decision makes sense to the person making it, given their unique experience of the world. You cannot judge others' financial decisions without knowing the full context of their life history. Modern personal finance tools are historically very new. We are all still learning. Emotional experiences with money are more powerful guides to behavior than intellectual knowledge. Chapter 2. Luck and Risk. Luck and risk are mirror images of the same force. Both reflect the reality that outcomes in life are influenced by forces entirely outside your control. Yet we systematically ignore both, because acknowledging them is deeply uncomfortable. Bill Gates and Kent Evans. In 1968, roughly 303 million high school-age people existed in the world. About 300 of them attended Lakeside School in Seattle, one of the only schools anywhere with a computer at the time. Bill Gates was one of those 300. He has said plainly, if there had been no Lakeside, there would have been no Microsoft. Gates was staggeringly talented and hardworking. But he also had a 1 in a million lucky break simply by being born in the right time and place. His friend Kent Evans was equally brilliant, by all accounts, the best student in their class and a likely co-founder of Microsoft. But Kent died in a mountaineering accident before graduating high school. Mountaineering deaths at that age, roughly 1 in a million. The same force, 1 in a million, worked in wildly different directions for Bill Gates, luck, and Kent Evans, risk. That's the duality at the heart of every outcome. Why we ignore both. We celebrate success as the product of skill and hard work. We condemn failure as the result of laziness or bad decisions. This is psychologically comfortable but often analytically wrong. When praising success, attributing it partly to luck seems jealous or mean. When judging failure, attributing it to bad luck seems like making excuses. So we default to, success equals skill, failure equals bad decisions. Both are oversimplifications that mislead us about how the world actually works. Nobel laureate economist Robert Shiller, when asked what he most wanted to know about investing that we can't currently know, answered, the exact role of luck in successful outcomes. The dangerous lessons problem. We learn by observing successes and failures. We look at Vanderbilt, Rockefeller, Gates, and Buffett and try to extract lessons. But the more extreme the outcome, the more likely luck played a significant role, and the less applicable those lessons are to your own life. Cornelius Vanderbilt broke laws routinely. It worked brilliantly, but recommending flagrant law breaking as entrepreneurial wisdom would be absurd. It worked for him partly because he got lucky enough to avoid consequences. Benjamin Graham's greatest fortune came from a massive stake in Geico stock that broke nearly every diversification rule he preached. As Graham himself wrote, one lucky break, or one supremely shrewd decision, can we tell them apart? The practical lessons. 2 principles can guide better thinking about luck and risk. First, be careful who you praise and admire, and who you look down upon. Success does not always mean the right decisions were made. Failure does not always mean the wrong ones were. Second, focus on broad patterns rather than specific individuals. The more extreme an outcome, the less applicable its lessons. Studying the general patterns of patient, long-term saving and investing yields more actionable insight than studying any single billionaire's journey. Nothing is as good or as bad as it seems. When things are going extremely well, you are not invincible. When they are going badly, you are not necessarily doing everything wrong. Key takeaways. Luck and risk are both real, powerful, and routinely underestimated. Success and failure are both less attributable to personal decisions than we like to believe. Study broad patterns, not extreme outlier stories, for the most applicable lessons. Maintain humility in success and forgiveness in failure, for yourself and others. Chapter 3. Never enough. There is no financial concept more dangerous, or more underappreciated, than the absence of enough. This chapter explores what happens when the goalpost never stops moving. 2 case studies in Never Enough. Rajat Gupta rose from poverty in Kolkata to become CEO of McKinsey, one of the most prestigious jobs in the world. By 2008, he was reportedly worth $100 million. A 5% return on that sum generates almost $600 an hour around the clock. He had everything, but surrounded by Goldman Sachs billionaires, he wanted more. He began passing insider information to a hedge fund manager. He went to prison. His career and reputation were destroyed. Bernie Madoff ran a legitimate, hugely profitable market-making business before launching his infamous Ponzi scheme. His legitimate business alone made him a wealthy man. Why did he risk it all? Because $25 minus $50 million per year was not enough when others were making more. He wanted more. The fraud collapsed, destroying thousands of lives and his own. To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. It is just plain foolish. Warren Buffett, on the collapse of long-term capital management. The 4 rules of enough. 1. The hardest financial skill is getting the goalpost to stop moving. When expectations rise as fast as results, you feel no progress despite genuine achievement. When the taste of more increases ambition faster than satisfaction, every step forward pushes the goalpost 2 steps further away. Modern capitalism excels at 2 things, generating wealth and generating envy. Happiness, at its simplest, is results minus expectations. 2. Social comparison is the problem. A baseball player earning $500,000 a year is objectively rich. But if he plays alongside someone making $36 million per year, he feels poor by comparison. The hedge fund manager making $340 million per year compares himself to those earning $770 million. Warren Buffett compares to Jeff Bezos. The ceiling of social comparison is so high that no one ever hits it. The only way to win is to refuse to play that particular game. 3. Enough is not too little. Enough is not deprivation. It is the recognition that an insatiable appetite for more will push you to the point of regret. The only way to know your food capacity is to eat until you're sick. No one does that, because vomiting hurts more than any meal is satisfying. Yet we routinely apply this logic to money, pushing until we break. 4. There are things never worth risking, no matter the potential gain. Some things are so valuable that risking them for more money is simply not a rational trade-off. Reputation, once lost, almost impossible to fully regain. Freedom and independence, the ability to live life on your own terms. Family and close relationships, the irreplaceable bonds of love. Being loved by those who want to love you. Personal happiness and peace of mind. The good news is that the most powerful tool for building enough is remarkably simple: understanding when to stop taking risks that could damage the things that truly matter. Key takeaways. The inability to define enough is one of the most dangerous financial traits. Social comparison is a game with no winner. The ceiling is always higher than you can reach. Some things, reputation, family, freedom, are never worth risking for more money. True wealth includes knowing when you have enough to be genuinely satisfied. Chapter 4. Confounding compounding. Compounding is the most powerful force in finance, and the most counterintuitive. Its true power is almost never fully appreciated, even by people who think they understand it. Ice ages and compound growth. The chapter opens with a surprising scientific lesson. What caused the ice ages? Scientists expected some titanic force, volcanic eruptions, shifting mountains, massive celestial events. The actual answer was far more subtle. Moderately cool summers meant winter snow didn't fully melt. The remaining ice made the next winter's snow more likely to stick, which reflected more sunlight, which cooled things further. A tiny initial condition, compounded over centuries, produced mile-thick continental ice sheets. It is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts. Glaciologist Gwen Schultz. The principle is identical with money. Small initial growth, compounded over long periods, produces results that seem to defy all logic. The real secret of Warren Buffett. More than 2,000 books have been written about Warren Buffett. Most focus on his investment strategies, the businesses he chooses, the prices he pays, the metrics he uses. But they systematically miss the most important factor. As of Housel's writing, Buffett's net worth was approximately $84.5 billion. Of that, $84.2 billion was accumulated after his 50th birthday. $81.5 billion came after he qualified for Social Security. His real secret is not intelligence or investment insight. It is that he has been a phenomenal investor since he was literally a child, starting at age 10, and has never stopped. Consider this thought experiment. If Buffett had started investing at age 30, rather than 10, with $25,000, rather than over $1 million, and earned the same extraordinary 22% annual returns, but retired at 60 to play golf, his net worth today would be approximately $11.9 million. That is 99.9% less than his actual fortune. Almost all of Buffett's success is explained not by the rate of return, but by the duration of compounding. Simons versus Buffett, the duration effect. Jim Simons of Renaissance Technologies has compounded at approximately 66% annually since 1988, roughly 3 times Buffett's rate. Yet Simons is significantly less wealthy than Buffett. Why? Simons didn't find his investing stride until he was 50. He has had far fewer years to compound. If Simons had earned his 66% annual return for the 70 years Buffett has been investing, his theoretical net worth would be approximately $63 quintillion. These numbers are absurd, but they illustrate the point. Time in the market, far more than rate of return, is the dominant variable in wealth accumulation. Why we get this wrong? Human beings are naturally linear thinkers. Exponential growth is profoundly unintuitive. Ask someone to calculate 8 plus 8 plus 8 plus 8 plus 8 and they can do it in seconds. Ask them to calculate 8 times 8 times 8 times 8 times 8 and most people dramatically underestimate the answer. This linear bias means we consistently underestimate how much wealth can be built through patient, sustained investment, and consistently overestimate the value of finding better investments with higher short-term returns. Good investing is not about earning the highest returns. It is about earning pretty good returns that can be maintained for the longest possible period. The counterintuitive nature of compounding leads even the smartest among us to overlook its power. The most powerful investing book ever written could simply be titled, Shut Up and Wait. Key takeaways. The power of compounding is almost always dramatically underestimated. Buffett's greatest advantage is not his skill, it is that he started early and never stopped. Duration of investment matters far more than rate of return for most people. Good investing means consistent, repeatable returns, not occasional spectacular ones. Chapter 5. Getting wealthy versus staying wealthy. Getting rich and staying rich are 2 entirely different skills requiring opposite mindsets. Most people who achieve great wealth have not mastered both, and the consequences are devastating. Livermore and Germansky, A Tale of Two Traders. Jesse Livermore was the greatest stock market trader of his era. In October 1929, as Black Monday, Black Tuesday, and Black Thursday wiped out a third of the market's value, Livermore made the equivalent of more than $3 billion in a single day. He had shorted the market brilliantly. His family celebrated one of the greatest trades in financial history. Meanwhile, Abraham Germansky, a successful New York real estate developer who had invested heavily in the surging market, was last seen on Wall Street tearing ticker tape into pieces and scattering them on the sidewalk. He was never heard from again. But fast forward 4 years. Livermore, now overflowing with confidence and making ever larger bets, lost everything. He eventually took his own life. The timing differed, but Livermore and Germansky shared a fatal character trait. They were both very good at getting wealthy and equally bad at staying wealthy. The survival imperative. If you had to summarize money success in a single word, Housel argues it would be survival. Compounding only works if you are in the game long enough for it to do its work. Being forced out, through excessive risk, leverage, panic selling, or financial ruin, breaks the compounding chain at the worst possible moment. This is why the ability to not lose is more valuable than the ability to gain. Notice what Warren Buffett did not do during his extraordinarily long investing career. He did not get carried away with debt. He did not panic and sell during the 14 recessions he lived through. He did not attach himself to a single strategy or trend. He did not rely on others' money. He did not burn himself out. He survived. Survival gave him longevity. Longevity made compounding work his magic. The Rick Guerin warning. Few people know the name Rick Guerin. Yet 40 years ago, he was the 3rd member of the Buffett-Munger investing partnership, equally smart, equally skilled. During the 1973-74 market downturn, Rick was leveraged with margin loans. The market fell nearly 70%. He received margin calls. He was forced to sell his Berkshire Hathaway shares to Buffett at under $40 each to cover his obligations. Charlie and I always knew that we would become incredibly wealthy. We were not in a hurry to get wealthy, we knew it would happen. Rick was just as smart as us, but he was in a hurry. Warren Buffett. 3 rules for surviving wealth. 1. Prioritize being financially unbreakable over maximizing returns. Cash feels like a waste during a bull market. You're watching the returns you're missing. But cash that prevents you from selling stocks at the bottom of a bear market may generate many multiples of its nominal return. Preventing one desperate, ill-timed sale can do more for lifetime returns than picking dozens of winners. 2. Plan for the plan not going according to plan. In the last 20 years, September 11th, a housing bubble that caused 10 million Americans to lose their homes, a financial crisis that cost 9 million their jobs, a record stock market rally, and a global pandemic. None of these were foreseeable. A good financial plan does not assume away uncertainty. It builds in enough room for error to survive it. 3. Cultivate a barbelled personality. Be optimistic about the long-term trajectory while being paranoid about short-term threats. These are not contradictory positions. The US economy has grown consistently over 170 years while enduring 9 major wars, 4 presidential assassinations, a devastating flu pandemic, and 33 recessions. Growth amid loss is the normal path of progress. Key takeaways. Getting wealthy and staying wealthy require opposite skills. Optimism and aggression versus humility and caution. Survival is the foundation of all long-term financial success. Avoiding ruin is more important than maximizing gains. Build financial plans with large margins of safety. Plan for the plan to fail. Chapter 6. Tails, you win. In any distribution of outcomes, a small number of events, the tails, at the far ends of the distribution, account for the vast majority of results. Understanding this is perhaps the most practically important insight in all of investing. Heinz Berggruen and the art dealer's secret. Heinz Berggruen fled Nazi Germany and became one of the greatest art dealers of the 20th century, accumulating a collection of Picassos, Braques, Clays, and Matisses eventually valued at over $1 billion. How? He did not predict which artists would become masters. He bought vast quantities of art and held them for long periods. Most of his acquisitions were worth little, but the tiny percentage that turned out to be masterpieces made the entire portfolio extraordinarily valuable. The great art dealers bought vast quantities of art. A subset of those collections turned out to be great investments, held long enough for portfolio returns to converge on the returns of the best elements. That's all that happens. Tails drive everything. This principle extends far beyond art collecting. In venture capital, out of more than 21,000 venture financings from 2004 to 2014, 65% lost money. 0.5%, about 100 companies, earned 50 times or more their invested capital. That 0.5% generated the majority of the industry's total returns. In public stock markets, in the Russell 3000 index since 1980, 40% of component companies lost at least 70% of their value and never recovered. Virtually all of the index's spectacular overall returns came from just 7% of companies that dramatically outperformed. The majority of stocks, even in a diversified index, were losers. But a small number of extraordinary winners more than compensated for all the losers. In Amazon, the company has experimented with hundreds of products. Most failed. But a few, Amazon Web Services, Amazon Prime, became enormous successes that more than justified all the failures. Amazon's Fire Phone was a costly disaster. Bezos said at the time, "We're working on much bigger failures right now. Some of them are going to make the Fire Phone look like a tiny little blip." What this means for investors? You will be wrong a lot. And that's completely fine. Peter Lynch, one of the greatest investors of all time, once said, "If you're terrific in this business, you're right 6 times out of 10. Warren Buffett has owned 400 to 500 stocks and made most of his money on 10 of them. Charlie Munger has stated, "If you remove just a few of Berkshire's top investments, its long-term track record is pretty average." The problem is that most people only see the finished products, the winners, not the enormous volume of failed attempts that preceded them. Chris Rock's comedy looks effortless on Netflix. What we don't see are the dozens of small club performances where he tested material and threw away the jokes that didn't land. The investor's practical application. Investor behavior during just a few critical moments, like late 2008 and early 2009, will likely have more impact on lifetime investment returns than everything you did in the preceding decade. Your success as an investor is determined largely by how you respond to those rare, terrifying moments when tail events occur, not by the years of calm, steady market conditions. A good definition of an investing genius is the man or woman who can do the average thing when all those around them are going crazy. Tails drive everything. Key takeaways. A tiny fraction of investments, decisions, or events account for the majority of outcomes. Being wrong most of the time is completely consistent with financial success. Staying in the game long enough to participate in the tail events is the central task. Judge your portfolio by overall results, not by individual wins and losses. Chapter 7. Freedom. The highest form of wealth is not a number in a bank account. It is the ability to wake up every morning and say, I can do whatever I want today. Control over time is the ultimate dividend. Psychologist Angus Campbell spent his career studying what made people genuinely happy. His landmark conclusion was that having a strong sense of controlling one's life was more reliably linked to happiness than income, education, housing quality, or geography. More than any of the objective conditions of life, the sense that you control your own time predicts your sense of well-being. Money's greatest intrinsic value, and this cannot be overstated, is its ability to give you control over your time. Not control in the abstract, but practical, daily control. Choosing your work, choosing your pace, choosing your priorities, choosing who you spend your time with. The investment banking lesson. Housel describes his experience as a summer intern at an investment bank. He had dreamed of this, the prestige, the money, the intellectual stimulation. What he discovered instead was that investment banking is financially lucrative precisely because it consumes your entire life. There was a saying in the office, if you don't come to work on Saturday, don't bother coming back on Sunday. He left after 1 month, not because he didn't love the work, but because every waking moment was controlled by his employer's demands. Doing something you love on a schedule you can't control can feel exactly the same as doing something you hate. The Derek Sivers story. Entrepreneur Derek Sivers tells the story of his path to financial independence. He had a day job in New York paying $20,000 a year. He lived frugally, spending about $1,000 a month and saving $800. After 2 years, he had $12,000. He quit his job and became a full-time musician. The difference happened when I was 22, Sivers says. Years later, he sold a company for millions. That didn't change his life in any fundamental way. The $12,000 that gave him freedom at 22 was the real transformation. The paradox of modern wealth. The United States is the richest nation in history. Yet there is little evidence Americans are, on average, happier than they were in the 1950s. Median family income has more than doubled in real terms. Homes are twice as large. Cars are faster. TVs are better. But time is harder to control than ever. The shift from manufacturing to knowledge work means that for a growing percentage of workers, the factory is wherever they have their phone. You're never fully off. You might be thinking about the marketing campaign while making dinner, lying awake at 3 a.m. with work anxiety, ruminating during your commute. Rockefeller, the chapter notes, spent much of his day sitting quietly, because his product was his thinking, not his labor. But he controlled when and how he deployed it. We've used rising wealth to buy bigger and better things while simultaneously surrendering more control over our time. At best, these trade-offs cancel each other out. Often, the loss of time control is the larger loss. No one, not a single person out of 1,000 elderly Americans interviewed, said that to be happy you should work as hard as you can to make money to buy the things you want. Gerontologist Carl Pillemer. Key takeaways. Control over your time is the highest dividend that money can pay. Happiness is more correlated with autonomy than with income or material possessions. Use money to buy time and options, not just things. Even a small amount of savings creates freedom that dramatically improves quality of life. Chapter 8. Man in the Car Paradox. This short but powerful chapter exposes a universal misconception about the relationship between wealth, status, and admiration. The paradox. Working as a valet in Los Angeles, Housel had the opportunity to drive some of the most expensive cars on earth: Ferraris, Lamborghinis, Rolls-Royces. He wanted one of these cars desperately because he believed they sent a powerful signal to others: you're smart. You're successful. You're important. Look at me. The irony, he almost never looked at the drivers. When a Ferrari rolled in, he thought, what an amazing car. I would love to be in that driver's seat. He never thought, what a fascinating and admirable person must be behind that wheel. When you see someone driving a nice car, you rarely think, wow, the guy driving that car is cool. Instead, you think, wow, if I had that car, people would think I'm cool. This is how almost everyone actually thinks, consciously or not. The core misalignment. People tend to accumulate expensive possessions in pursuit of admiration and respect. But observers use those same possessions as a benchmark for their own aspirations, not as a reason to admire the owner. The expensive car does not make the driver admirable. It makes other observers think, I want that. The driver is, in an important sense, invisible. The possessions are visible. The person behind them is not. What actually generates admiration? Housel wrote to his newborn son. You might think you want an expensive car, a fancy watch, and a huge house. But I'm telling you, you don't. What you want is respect and admiration from other people, and you think having expensive stuff will bring it. It almost never does, especially from the people you want to respect and admire you. Humility, kindness, and genuine empathy generate more lasting respect and admiration than any status symbol. The people others most admire tend not to be the flashiest, they tend to be the most interesting, the most generous, the most genuinely engaged with the world. Key takeaways. We buy expensive things to signal status, but observers are thinking about themselves, not us. The desire for admiration and respect is valid, but expensive possessions rarely deliver it. Kindness, humility, and empathy generate more genuine respect than material displays. Chapter 9. Wealth is what you don't see. Wealth and riches are not the same thing. Confusing them is the source of countless poor financial decisions and a misunderstanding that runs deep in modern consumer culture. The visible and the invisible. We judge financial success by what we can see. Cars, homes, clothes, vacations, Instagram photos. But these visible signals tell us almost nothing about actual wealth. Someone driving a $100,000 car might be wealthy. Or they might have $100,000 more in debt and negative net worth. You cannot tell from the outside. The person living in the mansion might have taken on enormous leverage to do so. The person driving the modest car might have millions quietly invested. Roger was a regular at the valet stand, always arriving in a Porsche. Then one day he arrived in a beat-up Honda. The Porsche had been repossessed. Every assumption about his financial status had been wrong. Los Angeles, Housel notes, is full of Rogers. When most people say they want to be a millionaire, what they might actually mean is, I'd like to spend $1 million. That is literally the opposite of being a millionaire. The true definition of wealth. Wealth is the financial assets that have not yet been converted into the stuff you see. It is the nice cars not purchased, the diamonds not bought, the watches not worn, the first-class upgrades declined, the larger home foregone. Wealth is options, flexibility, and growth, not consumption. The difference between rich and wealthy is crucial. Rich is current income, a high salary, a big bonus, visible spending. Wealth is accumulated assets net of liabilities, and by definition, it is invisible. You cannot see it, which means it is impossible to learn from. You can observe and imitate the behavior of rich people. You cannot observe and imitate the behavior of wealthy people, because their wealth is hidden. Learning from hidden success. Ronald Reed, the janitor who left $8 million to charity, was nobody's financial role model while living, because every penny of his wealth was hidden. After his death, his example became celebrated. But you cannot emulate what you cannot see. Housel compares this to learning to write without being able to read. Who are your models? Whose behavior do you study? Without visible examples of wealth-building behavior, most people default to imitating the visible behaviors of rich people, spending lavishly, which is precisely the opposite of what builds lasting wealth. Key takeaways. Wealth is what you don't spend, invisible accumulated assets, not visible consumption. The visible indicators of wealth, cars, homes, clothes, tell you almost nothing about actual net worth. Rich, high income, and wealthy, high net worth, are fundamentally different conditions. Because wealth is hidden, it is hard to learn from, creating a systematic bias toward imitation of spenders. Chapter 10. Save money. Saving money seems obvious. Yet most people do not save enough, not because they cannot afford to, but because they have not internalized why saving matters and what it truly buys them. Savings are about efficiency, not returns. In the 1970s, the world seemed to be running out of oil. The calculation was simple. The global economy consumed enormous quantities, demand was growing, and supply seemed limited. The oil crisis was inevitable. But the crisis did not arrive as predicted. Not because we found dramatically more oil, but because we became dramatically more efficient with the oil we had. The United States today uses 60% less energy per dollar of GDP than it did in 1950. The average car gets twice the miles per gallon it did in 1975. The lesson: the world grew its energy wealth not by finding more energy, but by needing less of it. The same principle applies to personal finance. Investment returns are uncertain. Market performance is unpredictable, but savings, what Housel calls finances conservation and efficiency, is entirely within your control and has a 100% chance of being effective. The three groups. Past a certain income level, people fall into three groups. Those who save, those who don't think they can save, and those who don't think they need to. This chapter is for the latter two. The ego-income gap. The most underappreciated driver of savings is not income, it is the gap between your income and your ego. Everyone needs basics. Once those are covered, spending beyond a moderate level of comfort is mostly a reflection of ego approaching income, spending money to signal to others that you have, or had, money. The most powerful way to increase your savings rate is not to earn more, but to raise your humility. When you define savings as the gap between your ego and your income, you understand why so many people with solid incomes save so little. People with enduring personal finance success, not necessarily those with high incomes, tend to have a propensity to not give a damn what others think about them. You don't need a reason to save. Most people save for specific purposes: a house, a car, retirement. That is wonderful, but there is a better reason to save. Life's inevitable ability to surprise you at the worst possible moments. An emergency fund is not primarily about emergencies you can predict, it is about the ones you cannot. Savings as a competitive advantage. In a world where intelligence is increasingly commoditized, where many previous technical skills are automated, where the global talent pool competes directly with you regardless of geography, flexibility may be one of the last remaining sustainable competitive advantages. Savings create flexibility. Flexibility creates opportunities. The person with a year of living expenses in savings can afford to wait for the right job opportunity, negotiate from strength rather than desperation, take a lower paying position with more purpose, or ride out a bear market without selling at the worst moment. These invisible options are an extraordinary return on wealth. Key takeaways. Savings are more about controlling expenses and ego than about earning more income. The gap between what you earn and what you need is more important than investment returns. Savings create flexibility and control, the most valuable and underappreciated financial assets. You do not need a specific reason to save. Saving for unknown future surprises is reason enough. Chapter 11. Reasonable, rational. Financial theory demands rational, emotionless decision-making. Real financial success often requires something different, and more sustainable, being reasonable. The malariotherapy lesson. In the early 1900s, psychiatrist Julius Wagner Jauregg discovered that fever could help the body fight syphilis. His solution: deliberately infect patients with malaria to induce fever. Some patients died, most recovered. He won the Nobel Prize. Eventually, penicillin rendered the treatment obsolete. But the broader lesson is fascinating. We know that fevers play a genuine role in fighting infection. We know that reducing fevers with medication may actually be counterproductive in some cases. Yet virtually everyone, patients and doctors alike, reaches for fever-reducing drugs the moment a temperature rises. Not because the science says to, but because fevers hurt. And nobody wants to hurt. It is rational to want a fever if you have an infection. But it is not reasonable. And when those conflict, reasonable usually wins. Why? Reasonable beats rational in finance. Academic finance optimizes for rational returns. But the mathematically optimal strategy and the strategy you can actually stick with are often different things. The latter is almost always more valuable. Harry Markowitz, Nobel laureate and father of modern portfolio theory, was once asked how he invested his own money. I visualized my grief if the stock market went way up and I wasn't in it. Or if it went way down and I was completely in it, he said. My intention was to minimize my future regret. So I split my contributions 50-50 between bonds and equities. Not optimal, but reasonable. And he could sleep at night. My own theory is that, in the real world, people do not want the mathematically optimal strategy. They want the strategy that maximizes for how well they sleep at night. The value of loving your strategy. An unconventional recommendation: love your investments. Not because it is rational, but because it keeps you committed during the inevitable downturns. Strategies you believe in emotionally have an advantage over technically superior strategies you abandon at the first sign of trouble. The historical odds of making money in US markets are 50% over one-day periods, 68% over one-year periods, 88% over 10-year periods, and 100% over all 20-year periods on record. Anything that keeps you in the game, including psychological comfort with your strategy, has a quantifiable advantage. Other, reasonable, behaviors. Home country investment bias is not strictly rational, But if it helps you stay committed to investing rather than holding cash, it has real value. Keeping a small portfolio of individual stocks alongside index funds may not be optimal, but if it scratches an itch and prevents you from making larger irrational decisions, it is perfectly reasonable. Jack Bogle, the champion of low-cost passive investing, invested some of his own money in his son's active, high-fee funds, saying, "We do some things for family reasons." Key takeaways. The best financial strategy is the one you can actually maintain, not the one that's theoretically optimal. Being reasonable and sustainable beats being rational and optimal. Emotional commitment to a strategy is a genuine advantage, not a weakness. Financial decisions are made by humans in complex social contexts, not by robots with spreadsheets. Chapter 12. Surprise. History is a useful guide, but its limitations are systematically misunderstood. Using the past as a direct blueprint for the future is one of the most common and costly mistakes in finance. The historians as prophets fallacy. History helps us calibrate expectations, understand human tendencies, and recognize patterns. But it is not, in any meaningful sense, a map of the future. Finance is a field where innovation and change are constant, where human behavior creates feedback loops, and where the most important future events are precisely the ones that have no historical precedent. Things that have never happened before happen all the time. Stanford professor Scott Sagan. Physicist Richard Feynman once said, "Imagine how much harder physics would be if electrons had feelings." Investors have feelings. Markets are made of human decisions. That is why historical data, while useful, cannot replicate or predict future market behavior with the precision of, say, orbital mechanics. 2 critical limitations of history. 1. Tail events dominate, and are unprecedented by definition. The most important economic events of any era are the record-breaking, tail-end events that have no prior parallel. The Great Depression had no precedent when it happened. Neither did World War II, September 11th, the 2008 financial crisis, or a global pandemic. 15 billion people were born in the 19th and 20th centuries. 7 individuals, Hitler, Stalin, Mao, Gavrilo Princip, Edison, Gates, King, arguably shaped more of the 20th century's history than all the rest combined. Their impact was unprecedented and unforeseeable. The same logic applies to economic history. A forecaster who uses the worst events of history as the basis for worst-case future scenarios is making a logical error. Those historical worst cases were themselves unprecedented. Future worst cases will be unprecedented in new ways. 2. Structural changes make old data misleading. The 401k is 42 years old. The Roth IRA is less than 30. Venture capital as we know it barely existed 25 years ago. The S&P 500 did not include financial stocks until 1976. Technology stocks were virtually non-existent 50 years ago. Benjamin Graham's investing formulas, widely considered among the greatest investment wisdom ever produced, have been updated and replaced multiple times since their first publication in 1934. Graham himself, shortly before his death, said he was no longer an advocate for the detailed security analysis techniques he had made famous, because the situation has changed a great deal. The further back in history you look, the more general your takeaways should be. Human tendencies toward greed, fear, and response to incentives are stable over time. Specific trading strategies, valuations, and sector behaviors are always changing. Key takeaways. History is a guide to human tendencies, not a blueprint for future market behavior. The most important future events will be unprecedented. History cannot predict them. Recent history is often more relevant than ancient history in finance, because structures have changed. Expect to be surprised. The correct lesson from past surprises is that the world is harder to predict than we think. Chapter 13. Room for error. The most undervalued concept in all of personal finance is the margin of safety, the gap between what you think will happen and what actually needs to happen for your plan to succeed. The card counter's wisdom. Professional blackjack card counters know with mathematical certainty that they have an edge over the house. They will win in the long run. But they also know that the casino will win 49% of individual hands. If they bet everything on every hand where the odds favor them, one bad streak will wipe them out. The card counter's rule of thumb: keep at least 100 basic betting units. If you start with $10,000, bet $100 per hand. This massive buffer means that even long runs of bad luck cannot destroy you, and you can stay in the game long enough for your mathematical edge to materialize. The power of margin of safety. Benjamin Graham defined margin of safety as the cornerstone of value investing. His favorite summary: the purpose of the margin of safety is to render the forecast unnecessary. You don't need to be right about the future. You just need enough buffer that even if you're wrong, you survive. Room for error is the only effective way to safely navigate a world governed by odds, not certainties. And almost everything related to money exists in that kind of world. Where room for error matters most: volatility and psychology. On a spreadsheet, you might be able to survive a 30% portfolio decline, your cash flow stays positive. But can you survive it psychologically? Will you lose confidence and sell at the worst moment? Will your spouse panic? The gap between what you can technically endure and what you can emotionally endure is one of the most overlooked rooms for error. Retirement planning. Historical average US stock market returns are around 6.8% annually after inflation. It is tempting to build a retirement plan on exactly that figure. But what if future returns are lower? What if your retirement date falls in the middle of a brutal bear market? What if you panic sell during a downturn and miss the recovery? Housel personally assumes his future lifetime returns will be 1/3 lower than the historical average, and saves accordingly. Leverage and ruin. Nassim Taleb's principle: you can be risk-loving and yet completely averse to ruin. Taking risks is necessary to get ahead. But no risk that can wipe you out is ever worth taking, regardless of the odds. Russian roulette offers favorable odds. The potential downside is still unacceptable. Guarding against the truly unforeseeable. During World War II, a German tank unit sat in reserve outside Stalingrad, its tanks idle. When they were desperately needed at the front, engineers discovered that field mice had nested in the vehicles and chewed through the electrical insulation. Out of 104 tanks, fewer than 20 were operational. The Germans had the most sophisticated military technology in the world. Nobody had planned for mice. And nobody could have. The most threatening risks are often the ones too crazy to cross anyone's mind. The only protection against completely unforeseeable threats is avoiding single points of failure. A sole reliance on a paycheck with no savings is a financial single point of failure. One bad event, illness, job loss, economic shock, can cascade into catastrophe. Key takeaways. Margin of safety is more important than optimizing returns. It keeps you in the game. Build financial plans that work even if your assumptions are significantly wrong. Never take risks that could produce ruin, regardless of how favorable the odds appear. Save for unknowable future surprises, not just predictable needs. Chapter 14. You'll change. Long-term financial planning is complicated by a profound psychological reality. The person you will be in 20 years is, in many respects, a stranger to who you are today. And you are systematically blind to this. The end of history illusion. Harvard psychologist Daniel Gilbert coined the term end of history illusion to describe a universal cognitive bias. We are acutely aware of how much we have changed in the past, but we consistently underestimate how much we will change in the future. People of all ages, 18 to 68, exhibit this bias. All of us are walking around with an illusion that history, our personal history, has just come to an end, that we have just recently become the people we were always meant to be and will be for the rest of our lives. Daniel Gilbert. The 5-year-old wants to be a tractor driver. The teenager wants to be a lawyer. The young lawyer discovers the hours are incompatible with family life and takes a more flexible job. The flexibility comes with lower pay, and they become a stay-at-home parent. At 70, they realize they're unprepared for retirement. Only 27% of college graduates end up working in their major field. The financial impact. Financial plans require commitment over time. Compounding requires consistency. But the end of history illusion means that plans made today may feel deeply wrong to your future self, and those plans may be abandoned at exactly the wrong moment. Charlie Munger's first rule of compounding. Never interrupt it unnecessarily. But how do you not interrupt a financial plan when your goals, values, and life circumstances change? This is one of the deepest tensions in personal finance. 2 practical responses. 1. Avoid financial extremes. The more extreme your financial choices, working 80-hour weeks to maximize income, or living so austerely you deprive yourself of everything, the more likely your future self will regret them. The benefits of extreme approaches wear off as you adapt. The costs, not being able to retire, having sacrificed decades to a single-minded pursuit, become permanent regrets. Moderate saving, moderate lifestyle, moderate flexibility throughout life increases the odds of sustained well-being. 2. Accept and forgive change. Daniel Kahneman is famous for his ability to completely abandon drafts he has worked on for months, saying, "I have no sunk costs." This is the right relationship with past financial decisions. Sunk costs anchor us to our past selves, strangers who had different knowledge, different values, different circumstances. Releasing past commitments without excessive guilt is not weakness, it is rational acknowledgement of growth. Embracing the idea that financial goals made when you were a different person should be abandoned without mercy, versus put on life support, can minimize future regret. Key takeaways. You will change significantly over time. Your financial plans must accommodate this. Avoid extreme financial positions that your future self may deeply regret. Build financial flexibility into your plans rather than locking yourself into rigid long-term commitments. Releasing past financial decisions without guilt, when your circumstances have changed, is wisdom, not failure. Chapter 15. Nothing's free. Every worthwhile financial reward has a price. But unlike most prices, the cost of investment returns is invisible, and this invisibility is the source of enormous financial mistakes. The hidden price tag. The S&P 500 increased 119-fold in the 50 years ending 2018. Holding a diversified portfolio of US stocks for the long run is one of the most straightforwardly lucrative strategies available to ordinary investors. But, hold stocks for the long run ignores how hard that actually is to do. Say you want an 11% annual return over 30 years. That reward does not come free. The price, enduring gut-wrenching volatility, constant doubt and uncertainty, periodic paper losses that may exceed 30 to 40% of your portfolio, and the persistent temptation to do something, anything, to make the pain stop. The shaded regions of any long-term stock chart show how frequently and severely the market traded below its prior highs. It is a constant, brutal reminder of what you are paying for your returns. Netflix stock returned more than 35,000% from 2002 to 2018, but traded below its previous all-time high on 94% of days. Monster Beverage returned 319,000%, but was below its prior high 95% of the time. Fee versus fine, the critical distinction. Why do so many investors try to avoid the price of investing, selling at bottoms, timing markets, switching strategies during downturns? Because the price of investing success is not presented as a price tag you can see in advance. It arrives as pain, doubt, and paper losses, which feel like punishments for doing something wrong, not as fees for getting something good. You would never steal a car rather than pay for one. But many investors effectively try to steal investment returns, capturing upside without paying the downside, through market timing, tactical allocation, and frequent trading. The vast majority fail. Morningstar found that 112 tactical mutual funds during 2010-2011 outperformed a simple 60/40ths portfolio on risk-adjusted measures in fewer than 9 cases. The irony, by trying to avoid paying the price, investors end up paying double. They miss the upside and suffer the anxiety of constant second-guessing. The Disneyland analogy. Disneyland tickets cost $100. That feels like a fee worth paying. You get a specific, enjoyable experience in exchange. Market volatility is the same. It is a fee, not a fine. You are paying for the right to participate in long-term market growth. Once you internalize this, you can endure the volatility without catastrophically overreacting to it. The trick is convincing yourself that the market's fee is worth it. That's the only way to properly deal with volatility, not just putting up with it, but realizing that it's an admission fee worth paying. Key takeaways. Every investment return comes with a price: volatility, uncertainty, doubt, and regret. The price is invisible until you're paying it, which is why it's so commonly avoided. Volatility is a fee for returns, not a punishment for bad decisions. Trying to get returns without paying the price, through market timing, almost always costs more than it saves. Chapter 16. You and me. Financial bubbles are not primarily driven by irrationality. They are driven by investors with different time horizons and goals taking cues from each other, not realizing they are playing entirely different games. The rational price illusion. There is a dangerous idea embedded in financial markets, that every asset has one rational price, shared by all investors. But investors have wildly different time horizons and objectives. A day trader, a 10-year value investor, and a long-term retirement saver looking at the same stock are essentially playing 3 different games. The price that makes sense for one makes no sense for the others. How bubbles actually form. Bubbles form when the momentum of short-term returns attracts increasing numbers of short-term traders. As more money chases momentum, short-term traders increasingly set the marginal price. Their logic is internally consistent. They plan to sell before the price falls. What looks irrational from a long-term valuation perspective is perfectly rational for a trader whose horizon is days or weeks. The dot-com bubble, Yahoo stock at $500 plus per share seemed insane from a fundamental perspective. But for a day trader planning to sell by end of day, it was perfectly fine as long as prices kept rising, and they did, for years. The bubble was rational, not for all participants, but for the subset of participants who were setting prices. The problem came when long-term investors began following the cues of short-term traders without recognizing they were playing a completely different game. Bubbles are not so much about valuations rising. That's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. The personal finance application. Spending decisions can be similarly contaminated by other people's games. A young lawyer aiming to make partner needs to project success through appearance. A writer who works from home has no such requirement. When the lawyer's spending sets the writer's expectations, the writer is mimicking behavior that makes sense for someone else's game, not their own. The most practical step: identify what game you are playing. Write it down. I am a passive, long-term investor optimistic about global economic growth over 30 years. Once that is clear, you realize that most of what the financial media discusses, this quarter's earnings, next year's recession odds, this week's market movement, is part of a game you are not playing. You can safely ignore it. Key takeaways. Different investors have radically different time horizons and goals. They are playing different games. Taking cues from investors playing different games leads to dangerous misjudgments. Bubbles form when short-term momentum attracts long-term investors who don't recognize the game has changed. Define your own investment game clearly and ignore information relevant only to other games. Chapter 17. The Seduction of Pessimism. Pessimism is intellectually seductive in a way that optimism is not. This asymmetry has profound consequences for how we think about markets, economies, and financial planning. Why pessimism sounds smarter. Tell someone that everything will be great and they will dismiss you. Tell someone they are in danger and you have their full attention. This is not irrational. Threats demand attention in a way opportunities do not. But in the domain of long-term investing, where the long-run trend has been upward for virtually every major market in history, this cognitive bias systematically leads to underinvestment and excessive caution. For reasons I have never understood, people like to hear that the world is going to hell. Historian Deirdre McCloskey. Financial pessimism commands more attention than optimism. Investment newsletters populated by prophets of doom attract subscribers despite, or because of, operating in a market that has grown 17,000-fold over the past century. Predicting recessions earns you media coverage. Predicting continued moderate growth earns you indifference. 3 reasons pessimism is so persistent. 1. Money affects everyone, so financial threats capture universal attention. A hurricane threatening Florida poses no direct risk to 92% of Americans. A recession threatens everyone. This universal relevance means financial bad news spreads further and captures attention more completely than comparable good news. Stock declines are reported in bold red letters. Stock gains are mentioned briefly. 2. Pessimists extrapolate current trends without accounting for adaptation. In 2008, environmentalist Lester Brown calculated that if China's oil consumption grew at the rate it had been growing, it would require 98 million barrels per day by 2030. More than the world was producing. He was right about the math. He was wrong about the outcome. He did not account for the fact that high prices would incentivize new drilling technologies, dramatically increasing supply. By 2019, world oil production exceeded 100 million barrels per day. Problems attract solutions in proportion to their severity. Markets adapt. Technologies improve. Human ingenuity responds to constraint. Pessimists who extrapolate bad trends in straight lines consistently miss this. 3. Progress is slow and invisible. Setbacks are fast and impossible to miss. The age-adjusted death rate from heart disease has declined more than 70% since 1965, saving roughly 500,000 American lives per year. The population of Atlanta, saved annually. But this progress happens so gradually that it captures almost no attention. A single terrorist attack, a plane crash, a dramatic market collapse. These happen suddenly and generate enormous attention completely out of proportion to their relative significance. The Wright brothers first flew in 1903 and almost nobody noticed for 4.5 years. A crash during an army demonstration in 1908 immediately became major national news. Good news accumulates slowly, bad news arrives suddenly. The short sting of pessimism prevails while the powerful pull of optimism goes unnoticed. Expecting things to be bad is the best way to be pleasantly surprised, which, ironically, is something to be optimistic about. Key takeaways. Pessimism sounds smarter because threats demand attention in a way opportunities don't. Pessimists routinely fail to account for human adaptation and market response to problems. Progress is slow and invisible. Setbacks are fast and memorable, creating systematic pessimistic bias. True optimism is not complacency, it is a belief that the odds favor a good long-term outcome despite setbacks. Chapter 18, When You'll Believe Anything. Stories are the most powerful force in the economy. When the stories we tell about the financial world change, so does the financial world, even if nothing tangible has changed at all. The Alien Observer. Imagine an alien observing the US economy from orbit on New Year's Eve 2007 and again on New Year's Eve 2009. The physical infrastructure is essentially identical, same factories, same universities, same roads, the same or better technology, smartphones that didn't exist in 2007. Yet between those two dates, US households lost $16 trillion in wealth, 10 million people became unemployed, and the stock market lost half its value. What changed? Not the physical capacity for wealth creation. What changed was the story Americans told themselves about the economy. In 2007, the story was, housing prices are stable, banks are prudent, financial markets price risk accurately. In 2009, that story had collapsed. And as the narrative changed, behavior changed. Credit froze, spending fell, jobs disappeared, the story became self-fulfilling. In 2009, we inflicted narrative damage on ourselves. Other than clinging to a new narrative, we had an identical, if not greater, capacity for wealth and growth. Yet the economy suffered its worst hit in 80 years. Two psychological forces that warp financial stories. 1. Appealing fictions. We believe what we want to be true. The more desperately you want something to be true, the more likely you are to believe a story that overestimates its probability. Financial quackery thrives because the stakes in investing are so high. Get a few picks right and your life transforms. People bring the same desperate credulity to stock tips that medieval people brought to plague cures. Bernie Madoff ran a scheme that should have been obvious. Guaranteed, smooth returns, audited by an obscure firm, with no explanation of how the returns were generated. Yet sophisticated investors gave him billions. He told a compelling story. They wanted to believe it. The Federal Reserve's own worst-case scenarios for 2008-2009 were wildly optimistic, not because of analytical failure, but because predicting a true recession is too uncomfortable for policymakers to allow themselves to do. 2. Everyone has an incomplete worldview, but tells a complete story anyway. A 1-year-old child knows almost nothing about the world. But she doesn't wander around in confusion. She has a complete internal narrative that makes perfect sense of everything she encounters, based on the tiny sliver of reality she has experienced. Adults are identical. We know a tiny fraction of what there is to know, but we construct complete, confident narratives from our limited perspective. This creates systematic blind spots. We cannot know what we don't know. We overestimate how much of our financial outcomes are within our control. Founders consistently estimate their startup success as 80% plus dependent on their own actions. We substitute hindsight for insight, creating the illusion that the past was predictable. Risk is what's left over when you think you've thought of everything. Carl Richards. Key takeaways. Narratives are among the most powerful forces in economics, more powerful than physical reality in the short term. We systematically believe stories that confirm what we want to be true. Everyone operates with a complete narrative built from an incomplete dataset. Acknowledging the limits of your knowledge is a genuine competitive advantage in financial decision-making. Chapter 19, All Together Now. This chapter synthesizes the book's key lessons into a set of actionable principles for better financial decision-making. These are not rigid rules, they are the kind of general principles that acknowledge human complexity while providing genuine guidance. The medical analogy. In 1931, Clarence Hughes went to the dentist, was anesthetized, and woke up missing 16 teeth and his tonsils, procedures he never consented to. His wife sued. The case illuminates how medicine once operated. Doctors knew best, patients' preferences were irrelevant. The goal was to fix the patient, full stop. Over the 20th century, medicine shifted toward treating patients, laying out options and letting patients make informed choices, because patients have wildly different values and risk tolerances. Financial advice requires the same evolution. What works for one person is wrong for another. There is no single answer. Universal guiding principles. Go out of your way to find humility when things are going right. It's never as good as it looks. Luck is real. When things go well, resist the temptation to attribute all of it to skill. The same respect for luck and risk that prevents arrogance also helps you identify better role models, people whose behavior is genuinely replicable, not people whose success is largely luck. Less ego, more wealth. Wealth is created by suppressing what you could buy today in order to have more options tomorrow. No matter how much you earn, you cannot build wealth without closing the gap between income and spending. Manage money in a way that helps you sleep at night. The foundational question for every financial decision. Does this help me sleep at night? This is not about maximizing returns. It is about finding a strategy you can maintain, which is ultimately more valuable than any technically optimal approach you cannot stick to. Increase your time horizon. The single most powerful thing most investors can do is simply extend how long they stay invested. Time is the most powerful force in investing. It makes small things grow large and allows big mistakes to fade. The historical odds of positive returns over 20-year periods in US markets, 100%. Become okay with many things going wrong. You can be wrong half the time and still succeed, because a small minority of outcomes account for most results. Judging your financial life by individual results rather than overall outcomes leads to constant second-guessing and irrational decision-making. Use money to gain control over your time. Not having control over your time is a powerful and universal drag on happiness. The ability to do what you want, when you want, with whom you want, for as long as you want, is the highest dividend money pays. Be nicer and less flashy. You probably want respect and admiration. Kindness and humility are more reliable paths to both than expensive possessions. Save, just save. You don't need a specific reason. Save for unknown future surprises. Everyone's life is a continuous chain of surprises. Savings that are not earmarked for anything in particular is one of the most powerful financial tools available. Define the cost of success and be ready to pay it. Nothing worthwhile is free. Most financial costs are invisible price tags, not visible ones. Recognize volatility and uncertainty as fees for returns, not punishments for bad decisions. Worship room for error. A gap between what could happen and what needs to happen for you to do well gives you endurance. Endurance is what makes compounding work its magic. Define the game you're playing. Make sure your financial decisions are not being driven by the behavior of people playing a different game with different time horizons and goals than you have. Chapter 20. Confessions. Chapter 20 is uniquely personal. Housel reveals his own financial philosophy and the specific decisions he and his family have made, showing the gap between what sounds best in theory and what actually works in practice. The question that matters. Sandy Gottsman, a billionaire investor, reportedly asks one question when interviewing candidates for his investment team. What do you own, and why? Not what you think is cheap. Not what you think will outperform. What do you personally own? The question cuts through theory to practice. Half of all US mutual fund portfolio managers invest none of their own money in their funds. Similarly, many doctors choose radically different end-of-life care for themselves than they prescribe for patients. The gap between professional advice and personal practice is enormous, and more revealing than any theoretical position. Housel's personal financial philosophy. The goal, independence. Housel's core financial goal is not maximum wealth or the highest return, it is independence. The ability to wake up every morning and choose what to do, when, and with whom. Every financial decision his family makes orbits around this central value. His parents lived through two phases, poverty and moderate prosperity. When his father finally became a doctor at age 40, after years of supporting 3 children through medical school on a minimal income, the frugal habits of scarcity remained. They lived well below their means. This gave his father the ability, after 2 decades of exhausting emergency medicine, to simply stop, one morning, to decide he had had enough and retire on his own terms. I did not intend to get rich. I just wanted to get independent. Charlie Munger. Savings strategy, lifestyle anchoring. Housel and his wife established a moderate lifestyle when they were young and earning entry-level salaries. Despite rising incomes over more than a decade, they have largely maintained that original lifestyle level. Almost every salary increase has gone directly to savings, what Housel calls their independence fund. They live considerably below their means. They rarely feel deprived, because their aspirations for more have not grown alongside their income. The worst financial decision, best money decision, trade-off. They own their house without a mortgage. This is, Housel freely admits, the worst financial decision they have ever made from a pure return perspective. Mortgage rates were historically low. Any rational advisor would recommend taking cheap debt and investing the difference in higher returning stocks. But that's the rational answer, not the reasonable one. The feeling of owning the house free and clear, the independence, the security, the permanent absence of a monthly mortgage obligation, is worth more to them than the theoretical return difference. They are optimizing for sleeping well at night, not maximizing mathematical returns. Investment strategy, simple index funds. Their investment approach, dollar cost average into low-cost index funds, a combination of US and international stocks. They max out retirement accounts, contribute to college savings plans, and otherwise let the investments sit undisturbed. Their entire net worth is essentially a house, a checking account, and Vanguard index funds. No complexity, no active strategies, no individual stock picking. This is not because Housel believes active investing is impossible. He believes it's simply hard and unnecessary for someone who can meet their goals without it. I can afford not to be the greatest investor in the world. I cannot afford to be a bad one. When I think of it that way, the choice to buy the index and hold on is a no-brainer. Large cash reserve. They keep approximately 20% of assets in cash, far more than most financial advisors would recommend. The reason, independence requires never being forced to sell stocks at the wrong time. Every time Housel hears about a large unexpected expense hitting someone's finances, he thinks, that's why we keep extra cash. The return on that cash is not 0%, it is the peace of mind and flexibility that prevents making one terrible decision at the worst possible moment. The first rule of compounding is to never interrupt it unnecessarily. Charlie Munger. No matter how their investment strategy evolves over time, Housel is confident their goal, independence, will remain constant. Everything else is details, and everyone's details will be different. What works for us may not work for you. But there is no single right answer, only the answer that works for you. Key takeaways from Chapter 20. The gap between what experts recommend and what actually works for you can be enormous. Define your personal financial North Star. Housel's is independence, yours may be different. Keeping lifestyle expectations anchored over time is one of the most powerful savings tools available. Optimizing for sleeping well at night is a legitimate and valuable financial strategy. Simplicity in investing, index funds held for decades, is a complete and sufficient strategy for most people. Postscript. A brief history of why the US consumer thinks the way they do. The book concludes with a sweeping historical narrative that provides essential context for understanding how modern American attitudes toward money, debt, and wealth were formed. This postscript explains why Americans think about money the way they do today. 1945 to 1973, the golden era of shared prosperity. World War II ended with an enormous question mark. 16 million Americans, 11% of the population, had served in the military. Where would they work? Where would they live? Economists feared a return to Depression-era conditions. The policy response was deliberate and transformational. Interest rates were kept low. The GI Bill offered mortgages with no money down. Consumer credit was deregulated. The first credit card appeared in 1950. Policymakers actively encouraged spending as an economic strategy, deliberately pivoting from the wartime culture of saving. The result was an explosion of consumer purchasing, cars, homes, appliances, TVs, fueled by pent-up demand from the war years, new middle-class manufacturing jobs, and cheap credit. Average wages doubled from 1940 to 1948, then doubled again by 1963. Crucially, these gains were broadly shared. The income gap between rich and poor narrowed dramatically. The top 1%'s share of national income fell from 13% to 7%. Ordinary families and wealthy families drove similar cars, watched the same TV shows, and lived in homes that were different in size but not entirely different in kind. Americans lived in one of the most economically equal societies in history, and this became the foundation for expectations about what normal American life looked like. 1973 to 1982, the cracks appear. The 1973 recession brought the highest unemployment since the 1930s. Inflation surged and stayed high. Interest rates hit 8% by 1973. Vietnam, political assassinations, riots, and the oil crisis combined to create a profound sense of national anxiety. Japan and Germany, recovering from wartime devastation, began competing seriously with American manufacturing. Baby boomers, coming of age with different expectations from those forged by depression and war, encountered an economy that was beginning to distribute its gains unevenly, but their expectations, formed in the era of shared prosperity, had not changed. 1982 to 2000, the boom resumes, but differently. Reagan's "Morning in America" was not hyperbole. GDP growth returned to 1950s levels. The S&P 500 rose almost fourfold between 1982 and 1990. Total real GDP growth in the 1990s was roughly equal to the 1950s. But the distribution was completely different. Between 1993 and 2012, the top 1% saw incomes grow 86%. The bottom 99% saw just 6.6% growth. The top grew explosively, the middle largely stagnated. Yet culturally, Americans maintained the 1950s expectation that their lifestyle should be roughly comparable to most of their neighbors. Now those neighbors included people who were genuinely, vastly wealthier. Madison Avenue and, later, the internet made the lives of the wealthy visible to everyone. A culture of equality innocently morphed into a keeping up with the Joneses effect, but now the Joneses were playing in a different league. 2000 present, the big stretch. The response, debt. Household debt to income climbed from around 60% in 1973 to more than 130% by 2007. The median new American home grew 50% larger during a period of stagnant median wages. Average car loans more than doubled in real terms from 1975 to 2003. Student debt exploded. America had spent 75 years building a cultural acceptance of household debt, beginning with the deliberately engineered post-war consumer boom. Now that cultural acceptance was carrying people well beyond what was sustainable. In 2008, Hyman Minsky's moment arrived, the point when people took on more debt than they could service. The economy collapsed. The decade of recovery that followed paradoxically perpetuated some of the underlying inequality. Quantitative easing boosted asset prices, benefiting those who owned assets. Tax cuts predominantly benefited high earners. The current moment. Tea Party, Occupy Wall Street, Brexit, Donald Trump, these represent diverse groups shouting, in different ways, this isn't working. And at the root of much of this frustration is the gap between the post-war expectation that American life should be roughly comparable across income levels, and the reality of a sharply stratified economy. Expectations move slower than reality. People clung to 1950s economic expectations as the economy changed around them for 35 years. Even if a middle-class boom began today, the sense that the odds are stacked against everyone but the wealthy may persist for decades. Housel is not pessimistic. Economics is cyclical. Progress continues. But understanding how we got here, the deliberately engineered consumer culture, the long era of genuine shared prosperity, the slow drift into inequality, the debt-fueled attempt to maintain appearances, is essential for understanding why Americans think about money the way they do today. Conclusion: the most important lessons. The Psychology of Money is not a book about get-rich formulas or investment strategies. It is a book about the human beings behind financial decisions, the emotions, biases, histories, and stories that drive behavior more powerfully than any spreadsheet ever could. The central thesis, demonstrated through 20 stories and insights, is deceptively simple. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. And behavior cannot be engineered away through better models or more information. The 10 most powerful ideas in the book. 1. No one is crazy. Every financial behavior, however strange it appears from the outside, makes sense to the person doing it given their unique history and experience. Judgment and understanding require knowing that context. 2. Luck and risk are two sides of the same coin. Success is never purely the result of skill, and failure is never purely the result of bad decisions. Maintaining humility about both leads to better decisions and better relationships. 3. Knowing enough is one of the most important financial skills. The inability to define enough has driven some of history's most talented people to catastrophic self-destruction. The goalpost must eventually stop moving, or the race can never be won. 4. Compounding requires time above all else. The most important investing variable for most people is not rate of return, it is how long you stay in the game. Patience, consistency, and survival are the true sources of compounding's magic. 5. Survival is the foundation of all financial success. Getting wealthy and staying wealthy require opposite skills. The ability to not lose, to survive bad markets, bad years, and bad luck, matters more than the ability to gain. 6. A few tail events account for most outcomes. Being wrong most of the time is completely compatible with financial success. What matters is staying in the game long enough for the rare exceptional outcomes to occur. 7. Control over time is the highest dividend money pays. More than any material possession or status symbol, the ability to spend your time as you choose is the most powerful return on financial wealth. 8. Reasonable beats rational. The best financial strategy is the one you can actually maintain under real-world emotional conditions, not the one that's theoretically optimal but psychologically unsustainable. 9. Build in room for error. Plans that only work if everything goes according to plan are fragile. The margin of safety is the most undervalued concept in personal finance. 10. Stories drive more financial behavior than facts. The economy is shaped as much by the narratives we tell ourselves about it as by physical reality. Understanding this is essential for both navigating markets and making personal financial decisions. Ultimately, Morgan Housel argues that financial success is less about intelligence, information, or sophistication, and more about having a handful of behavioral skills that align how you act with what actually leads to long-term wealth. These are soft skills: patience, humility, frugality, perseverance, the capacity to say, enough, but they are the skills that separate those who thrive financially from those who do not. The Psychology of Money reminds us that being kind to yourself, accepting uncertainty, building margins of safety, and taking the long view are not compromises or workarounds for a lack of sophistication. They are the most sophisticated financial strategy available to most people. No one is crazy. We are all, as Housel says at the very end, navigating an extraordinarily complex world with imperfect information, shaped by our own unique histories. The wisest financial behavior acknowledges this, builds in room for error, and endures.